Hello everyone, thank you so much for joining us for the JNCC's Natural Capital Seminar Series. This series is being run as part of our wider CPD training and aligns with our overall strategy to understand how biodiversity relates to other aspects of the natural environment and how it underpins ecosystem services to provide benefit for society and the economy. We are recording this seminar, so if you could please keep your cameras and microphones off while the talks are going on, that would be great. Today we have two invited speakers who will present for approximately 20 minutes, and then we'll have time at the end to go through questions and have a bit of discussion about the talks. If you could please also avoid using the chat while the talks are ongoing, because it can be a bit distracting. That'll be great. Instead, we will be using Slido. We'll paste the link in the chat a couple of times throughout, and you'll also have the opportunity to ask questions at the end. So this is the second talk in our series, and we're focusing on natural capital finance in practice. I think quite a few of you were able to join us for the first session on marine natural capital last week. And we hope to see many of you again for our terrestrial session next week. There will also be a final session in early December where we're going to showcase some of the JNCC's ongoing projects. If you experience any technical issues today, please message myself or Lauren, and we'll try and get them sorted. So today we are joined by Dr. Katherine Simpson and Natalya Kharadi. Katherine is a research fellow at the University of Glasgow and works on biodiversity offset markets. Natalya is senior consultant at eftec and has worked on a wide range of natural capital accounting and valuation projects. So without any further ado, we'll launch right into our first talk. So thank you very much, Katherine.
Lovely. Thank you for the introduction, Poppy. So today I'm going to talk through the research that we've been undertaking at the University of Glasgow since 2018. So kind of broadly setting up environmental markets, and then I'll go into the specifics of our research, which is on biodiversity offset markets and also in the context of net gain. So what do we mean? So when we're thinking of environmental markets, so I'm sure everyone on the call doesn't need me to tell you 75% of our land is degraded globally, predominantly due to the actions that we've been undertaking as humans for agriculture, for development, and that's led to significantly negative impacts on climate and our ecosystems. And we've now got so many different global policies, predominantly the UN Decade of Restoration, but also things embedded within climate policies as well on how we can start to improve our natural environment. So as economists, we're always looking at tools on how we can incentivize people to behave differently. So one of these is environmental markets. And the idea is what we're wanting to do is to reward landholders for undertaking sustainable land management actions that could benefit the climate and also different ecosystems and biodiversity. So the idea is we have a landholder, and probably at the moment he is receiving income for traditional marketable ecosystem goods and services such as food production, timber production, but he's also supporting and delivering things like biodiversity, carbon sequestration, and water quality on his land as well. And the idea is we want to reward farmers for delivering these. And one such way we can do this is through environmental markets by allowing them to sell different types of credits. So a biodiversity credit, a carbon credit, a water quality credit. And these are purchased then by buyers, so such as government, housing developers, general public and companies who wish to offset their negative environmental impacts. Now, one of the widest, most well-researched is the voluntary carbon market. That's currently valued, I think it's, when I checked this morning, it's something like 760 million euros. But there are other markets coming on stream, so biodiversity, also water quality. And I'm just going to talk about really the biodiversity offset market today and putting it in some UK perspective. So when we started looking at biodiversity offset markets back in 2018, this was very much off the back of the DEFRA pilots that were conducted 2012 to 2014 on whether we could implement biodiversity offsets to allow housing developments to go ahead and whether we could offset these through a tradable credit. So there were 6 pilots that were undertaken in England. At the time, it wasn't particularly successful. One of the real difficulties was actually securing any landholders that were willing to come on board and provide the habitat banks within the framework. Now it's very much been rebadged as biodiversity net gain, and it's been mandated through the Environment Act. So it's now developers are required to demonstrate a 10% uplift in biodiversity as part of their planning consents in England. And one way they can do this is to purchase biodiversity offset credits. And we now, of course, we have the DEFRA metric 3.0. So caveat is today, I'm not going to be doing any work on the DEFRA metric, but I do know that's out there. But I'm not going to talk about that specifically. In Scotland, the kind of key environmental market, and this is what's interested me going forward, and I'm going to give you a pitch at the end, is very much the carbon market. So as part of Scotland's Net Zero 2045 strategy, the carbon market is seen to have a key role, and the Scottish Government wants to increase the woodland carbon market by 50% by 2025. Now, what we're already seeing in Scotland is a significant uplift in rural land prices, and this is driven by private investment companies purchasing old Scottish estates with the sole purpose of essentially woodland reforestation to access the carbon market, and potentially looking at whether they can demonstrate a biodiversity uplift as well to create a bundled nature climate credit. And this is really causing concerns as part of the Scottish Land Commission, mainly due to what's going on in terms of Scottish land reform at the moment as well. So, but for now, I'll take a step back to where we started this research for markets for biodiversity offset. So we were very much coming at this with our environmental economist hats on. And the first thing we wanted to do was look at the lessons we could learn from the carbon trading market and see how, if we wanted to create a successful market for biodiversity offsets, what lessons could we take across? And really the crucial one is having this single unit of exchange. So within the carbon market, it's really tangible that you're trading one unit of carbon and it's straightforward to measure. Problem as soon as we say biodiversity, how do you define it and how do you turn that into a credit? So that's something that always really interests us. And it's also, if we look at the ecological disciplines, it's really that choice of the metric is going to be so critical in whether your offsetting policy is successful or not. So these questions were coming up in terms of what to trade and how to trade. Also our exchange rate. So how many units of biodiversity are we trading across space? So is it 1-to-1 trading, or do we even want a trading ratio of 10-to-1? So if you're losing 1 unit of biodiversity, do you want to trade that off with 10 units of biodiversity elsewhere? That's what I mean by an exchange rate. What we found is a lot of this literature and the modelling was in ecology, and there'd been very little quantitative work from an economics perspective and bringing in other valuations to this. So this set up for our research going forward, and we had a series of research questions that we wanted to answer. So the one I'm going to talk to you today is the critical one. So how does the choice of the offset metric affect the ecological and the economic land scale outcomes? But we also considered the scale of the market. So how far are you making this trades over? Should it be very localized, or can you go across a region? And also, how does the price and quantity of what we trade shift under increasing requirements for biodiversity net gain as well? So one slide on the theory, and I've kept the algebra to minimum, so not included any. So how did we set this up? So it is a model. So it is a simplified version of reality. And what we're looking at within our landscape is you have landholders and they can make a series of decisions. So they're our agents. And this is all based on the economic rents or the profits of these land parcels. And they can either be developed, remain as agriculture, or go into conservation. So our landholders can choose to become an offset provider. And to do that, they need to be offered a credit value equal to the minimum of their agricultural rents forgone. And if that happens, they're going to choose to undertake some restoration land management actions and then sell these credits on an environmental market. Our developer, so for the housing to go ahead, they must purchase offset credits equal to the number of biodiversity offset units that we're going to lose. But also to factor into that, the developer is only going to want to develop if their profits are going to be greater than the agricultural land that they currently have. And why this is interesting, obviously we expect agricultural and development rents to vary across a landscape due to differences in land productivity and also home buyers' preferences on where to live. So obviously we also need to bring in the ecology into this, and we do this through an integrated ecological modelling approach. And there's 3 stages, and I'll show you each stage in more detail in a moment. But we're using species abundance modelling in R, an agent-based model in Stata, and then we look at the landscape scale outcomes in GIS. And essentially we've built these pretty comprehensive data sets on a 1x1K grid for our case study regions. And we're integrating data from the breeding bird survey. So that's going to be our species metrics. Land cover classifications using Centre of Ecology and Hydrology's land cover maps. Value of agricultural land based on data from the SRUC Farmland Management Handbook. And also the land soilscape maps for fertility. So our case study regions, so we had 2. Case study region 1 was in the central belt of Scotland, and this is this enlarged figure here. So it's covering, we've got Edinburgh at the kind of the head of around the Forth estuary. We also head across towards Stirling, down into the Pentland Hills, and just heading slightly north as well. Our second case study region that we modelled this for, number 2, was the Tees Valley and the Pennine Upland. So they're broadly similar landscapes. So the areas with this heavy industrialisation around the estuaries themselves, spreading out to more moorland and upland landscapes. So there's quite a variation in the habitats and the land uses. So the first thing in our modelling approach is to decide what policy. So what we were wanting to compare is a no net loss policy for one type of habitat, which is a low intensity grassland, compared with a no net loss policy of lapwings. And the reason we did this is that we know lapwings value low intensity grassland, but what we wanted to see was a simpler policy, which was just no net loss of a habitat. Could that still actually mean that we would get no net loss of lapwings or not? So that was what we were wanting to compare here. So we undertook species abundance modelling. So we had our lapwing data from the breeding bird survey, and we wanted to predict the current abundance of lapwing in our case study region. That's what I'm showing you in this figure here, and predict how this lapwing abundance would change if all agricultural land parcels in the landscape could switch their agricultural production to low intensity grassland. We also wanted to look at parcel-specific predictors of lapwing abundance as well. We also run species abundance modelling for curlew and oyster catcher as well, as we wanted to look at how their populations would change under this biodiversity offset market setup as well. So once we have these specific predictors, we then feed this data into our agent-based model in Stata. And essentially what we're doing here is looking at these economic decision-making of our agents. So we want to calculate the willingness to accept of farmers to become an offset supplier. and the willingness to pay of housing developers to purchase an offset credit. And what we're wanting to construct is the supply and demand curves for an offset market. So you can see the thin blue line here. That is our offset suppliers, our farmers. And then in the green, that's our offset demand. And what we can see at one point, then these two lines cross, and that's going to give us our market equilibrium price for an offset. So essentially what we can then do is within our agent-based model, we can model the trading process between the land parcels that are going to purchase offset and the land parcels that are going to want to sell the offsets. And then we plot this over space within ArcGIS. So what findings were we getting? So firstly, we ran this as simply they were trading habitat. So it was hectares of low intensity grassland. So what we find is our market equilibrium price for a hectare of low intensity grassland, our market clears. So what that means is we get the same amount of hectares of grassland developed as the same amount of hectares of grassland restored. And we can see our developed parcels are these black parcels within the landscape, and our offset supply sites are these areas in brown. And what you can see is under the habitat metric, actually the offset supply sites are not where we're finding our high predicted lapwing distributions. And what that was meaning is, so despite we know low intensity grassland benefiting lapwing, actually in this trading setup, we were still getting significant declines in lapwing and also in curlew. So whilst yes, we were getting no net loss of habitat, it wasn't very beneficial to a closely related species. So then going on to a species metric. Okay, so now we're looking at no net loss of lapwings. So actually what we can see now is surprisingly, we're actually getting a lot more development taking place at the market equilibrium. So we're getting a huge amount of development on low intensity grassland, but crucially, this is no longer where our lapwings are found in the landscape. And what we're seeing is our offset supply sites, which are in brown, are now crucially found in areas where we have this high predicted lapwing abundance. And we're having fewer offset banks for lapwings created, but they're in really high value areas for lapwing. So what we can then do is compare across these different metrics. So if we had along the top, we have no net loss of grassland, what would happen in that market? What would happen if it was no net loss of lapwing? What would happen in that case? And no net loss of curlew, what would happen? So like I was saying, what we can see is if we have no net loss of lapwing or no net loss of curlew, we're getting these really substantial declines in grassland, but we are getting no net loss of the metric, but we are still getting declines in our non-target species. So we are still getting losses of curlew when we're focused on lapwing, or we're getting losses of lapwing when we're focusing on curlew. But crucially, these are a lot less than when we're just going for a habitat-based metric. So what we're actually finding specifically for our landscape is that trading habitats is leading to a net loss for species. And this is because those land parcels for development, their development rents is positively correlated to our predicted increases in species abundance. And it's also found on sites that offer lower agricultural rents. So the likelihood is that development is going to take place on parcels that have got potentially high levels of lapwing or curlew. Coupled with that is the agricultural parcels with the lowest agricultural rents are the ones that benefit lapwing and curlew, are the same parcels that are more likely to be developed for housing. So there's this whole scale of everything is driving development and agricultural production in this landscape. So what does the implications of this? So if we're aiming for a metric to act as an indicator to mitigate impacts on a range of closely related habitats and species, then a really simple no net loss target is not going to be accurate. We have to take into account the underlying species distributions led with the agricultural and development rental values of parcels. Otherwise, and we're going to get a very different landscape outcome depending on the metric that we choose. So if we're wishing to secure the most ecological beneficial design of an offsets policy, either habitats or species, we need to understand the economic decision-making processes of landowners. And we need to design incentive-based policies that offer the highest incentives for conserving and enhancing the most ecologically beneficial sites in a landscape. So just to finish off, I'm almost at the end. I'm conscious of my time. So where do I want to go with this next? Well, I'm currently writing my fellowship application to develop a research team at the University of Stirling across biological and environmental sciences and the economics department. And we want to broaden this out into bringing together nature and climate positive environmental markets. And there's this big drive now to essentially stack and bundle multiple types of environmental credits. And this is really being driven by those private investors that I mentioned at the beginning that is affecting Scottish land use, the Scottish land markets. In England, this is very much being driven by biodiversity net gain within the Environment Act, but also coming on stream is alternative finance mechanisms for your agricultural landholders through the new environmental land management schemes, and also the voluntary carbon market will be coming to England. So what this research project wants to do is to deliver the much needed evidence on how we design, implement and validate these multiple environmental markets. Crucially is delivering landscape maps for Scotland and Northern England under alternative design. So how we measure carbon and biodiversity, but how we design stacked or bundled credit markets. And the way I'm going to do this is going beyond just the ecological economic modelling that I've done at the moment, and is working with specific stakeholders. So I already have working with me going forward. We have Plan Vivo, who is a credit broker at the moment in the global south, but they're looking to develop a nature-based credit for the UK market. Highlands Rewilding, the Woodland and the Peatland Carbon Code, also the Environment Bank, Galbraith, who manage many of the land transactions across Scotland, and also Nature Scot. What are you missing out on, though, at the moment is an English policy or practitioner who is interested in collaborating for the North East England case study that I'm developing with Newcastle University. So that's my kind of plea. If this sparks anyone's interest and they want to get in touch, that would be great. But there's my contact details as well. If you're interested in any of the work that I've talked about, and I can share our research with you in more detail. So yeah, thank you. And I've stuck to time.
I will now hand over to Natalya for our second talk.
Yeah, so hi everyone, my name is Natalya Kharadi. I'm a senior consultant at eftec, a consultancy based in London that specializes in environmental economics and its application. So today I have been invited to talk about natural capital accounting in practice, reflecting a lot of eftec's experience. So what I'm going to cover today is a little bit about who eftec is, for those of you that don't know, and how that links to accounting, of course. Concepts around natural capital accounting, how we generate evidence, and hopefully 2 examples. If not, I will just focus on the one, which is the Montserrat 2020 ecosystem account, to flag that some of this is work that we've done either commissioned by JNCC or in partnership with JNCC over time. So this might not be new information to some of you on this call, but hopefully will level out the base knowledge across the organization. So who are eftec? This is just a small infographic showing kind of who we are. Like I said, we're a small consultancy in London, or small-ish. We're now 28 people. Been around since 1992, working predominantly across 6 service areas. We have 700 plus projects under our belts, 100 of which are natural capital accounts or assessments. And we've done this in countries across the world with people across the world, basically, and through support with associates and ourselves. So natural capital accounting, just generally, the use of natural capital accounting in the UK is continuing to grow, and we've seen a large uptick in its application across the public and private and third sectors, specifically in the last 5 years, I'd say. The practice itself of accounting, or the process of undertaking a natural capital account, has been demonstrated in the UK through various kind of policy drivers or publications, including the UK Roadmap for National Natural Capital Accounts, which is driven by DEFRA and ONS, but also by the Treasury through the UK Green Book, where they've incorporated natural capital valuation and made specific reference even to DEFRA's Enabling a Natural Capital Approach, i.e. ENCA, which was published in 2020 with ENCA, if you're not familiar, is a data repository for valuation evidence, for UK-focused valuation evidence, and like the title says, it does enable a natural capital approach and ensures some consistency across the country, really. Natural capital accounting also links to other initiatives, which I've listed a few here on the screen. The most predominant in the UK, at least, is the British Standard on Natural Capital Accounting for organizations. But also there are national standards, including the UN's System for Environmental Economic Accounting Ecosystem Accounts, which is adopted as a statistical standard in March 2021. However, natural capital accounting also has links to other global initiatives, including the UN Sustainable Development Goals, and not exclusively the environmental SDGs, but it can show and provide indicators for things like sustainable cities, and also the World Bank Wealth Accounting Program, or WAVES, is also a link here. Just to flag that throughout this presentation, I will also be using natural capital accounting and ecosystem accounting interchangeably. So as you can see, the British standard has a slightly different name to the UN standard, but effectively they both still try to answer the same questions and follow the same framework, which is what I'll go through in a moment. So what we have here is basically these initiatives and even the practices in the UK do illustrate some differences in reporting structure, but the overarching natural capital accounting process ensures that all relevant data and or indicators are presented systematically, which I'll highlight in my examples that I'll go through in a moment. This is just a map kind of to showcase where eftec at least has done work and how we've fed in how natural capital accounts and assessments have been applied in our project portfolio, basically. So we've done a lot of work across the UK for various either government bodies or private sector organizations, including the Port of London Authority, but also Greater London Authority, the Duchy of Cornwall, things like that. We've gone beyond and looked at UK national accounts, specifically in collaboration with DEFRA and ONS, but also the UK overseas territories in the Caribbean, as I mentioned, through JNCC. We've also looked across the EU, feeding into their commentary on the UNCA guidance via Eurostat, and as well as our work has kind of gone further into standards and technical advice, most notably for the Capitals Coalition and also the Natural Capital Committee. We're starting to get into working with investment managers, which you can see down here in the bottom corner. So kind of land-based investments around the world, as you can see those little green dots everywhere. So it's growing, its application and use is growing not only in scale, but also in types of applications. So it varies from site level accounts to regional accounts to national, as you can see here. But fundamentally, it's all the same concepts and you aim to answer the same questions, which is what I'll take you through now. So our starting point really is that the environment is an asset, i.e. natural capital, where natural capital, at least defined by the Natural Capital Committee, and probably the most well used or the most consistently used definition for it, is the part of nature which directly or indirectly underpins value to people. It includes both biotic and abiotic natural resources, flora, fauna, the aquatic environment, terrestrial environment, soils, minerals, the atmosphere, and all the natural processes and functions in between. So it's quite a wide definition and scope. And how we deal with it really is by through an accounting framework. So a natural capital account answers a set of 5 questions, and those 5 questions each produce an accounting output. The first one being, what natural capital assets do we own, manage, or depend on? So this is all summarized in what's called a natural capital asset register, or an ecosystem extent account, or an ecosystem condition account. So all this is collates information on all your natural capital assets that are either owned, managed, or dependent on, if this is from an organization perspective, but also from a national perspective. So this is kind of where you start to see this, the importance of stocks. So this is your stocks of your assets. Based on what you own and what we have, so your long list of habitats, let's say, you can then determine what flows of benefits these assets produce. That's all summarized in a physical flow statement, and this is where your benefits are quantified in physical terms. This means things like tons of carbon sequestered, for example, or tons of food produced, number of livestock heads, things like that, are all summarized here. So there's a stock and a flow concept that runs throughout natural capital accounting. So you're considering both at all times, both with respect to quality and quantity, and how the quality and quantity of your asset impacts your flow of benefits. From there, we ask ourselves, what is the value of these benefits and to whom do they accrue? This is summarized in a benefit valuation statement, or a monetary flow statement is sometimes the term used. And this is where we show the monetary value of the benefits where possible. Note that it's not the main aim of natural capital accounting to always monetize benefits, but we do tend to do it where possible and where relevant. And within that, also identify beneficiaries, so i.e. to whom do these benefits accrue to. For organizations, it's clear that there are some private benefits, so things like income from recreation activities that an organization may run. That's one side of the benefit, but also there's clearly a wider societal benefit of having recreational access, so access to green space, things like that might be managed by someone else, or might be managed by the organization doing the account itself. So within this, we're going one step further. At least for organizations, we also look at what does it cost them to maintain your natural capital assets. This is summarized in a maintenance cost schedule. And this refers to both production costs, so costs related to supporting benefit provision. So if we continue with the recreation example, this would reflect costs associated with, for example, maintaining a footpath, maintaining a green space, things like that, as well as other natural capital maintenance costs, which may capture kind of general maintenance of the environment. So tree surveying, as is one example that we tend to see a lot with our clients. After you've kind of understood what you have, what it provides, the value of that, and what it costs you to maintain it, we look at then what is the net impact on natural capital. And this is then summarized in a natural capital balance sheet. And this takes a forward-looking is a forward-looking tool, basically, that looks at the sum of natural capital benefits over time against the sum of the costs to maintain the assets. We do this through, we basically calculate asset values, which are benefit values produced and costs produced in present value terms, and discounted in line with, in the UK at least, in line with the Treasury's Green Book guidance on discounting and economic appraisal more broadly. So the whole natural capital accounting process and is built on stocks and flows, but also looking at how both stocks and flows are likely to change in the future. It also considers dependencies of economic activity on natural capital and your ecosystem assets, but also the impact an organization or an individual may have on natural capital and those ecosystem assets. Main thing to note here is that with national accounts, so when you're abiding or following the UNCIA guidance, maintenance costs don't tend to be factored in. However, the general structure still applies, where you're still asking what assets are within the accounting boundary, what benefits flow from them, what value and to whom do those benefits accrue to, and what's the impact over time. You still have this time, this forward-looking element built in within it. So what the approach itself allows you to do is, or what it does really, is that it makes the most of available information by bringing together data and information on assets and their value to a business, people, governments. The list goes on. It uses a consistent and replicable format to show material benefits and risks, and builds on existing financial ESG data, adding value to both, but also environmental data, socioeconomic data that you might have access to. It's built on transparent methodology and assumptions and calculations. In the UK, that tends to be linked to things like ENCA, as I've already mentioned, Green Book guidance. There are lots of different evidence sources for this already in place. You are encouraged, at least at the BSI, for example, to speak to different stakeholders, gather data from them, but also their insights on what is the state of natural capital around them, what do they see. It also ensures that the account itself is comparable across space and time, as you have to clearly define your accounting boundary, your assessment period. And all of this in and of itself allows the whole account to be auditable by third parties. So it's a relatively robust approach and process. There are many examples. ENCA, I will keep mentioning, is a good place to look. There is a separate case studies Excel workbook that can be downloaded off of the website, so which DEFRA reviews internally and kind of publishes the best ones the ones that they want to include, basically. So what has accounting done for our clients? So traditionally, natural capital assets have been seen as freely available, substitutable, or somebody else's responsibility. However, we're seeing over that this perception is changing, and even more so recently that accounts monitor funding flows and flows of ecosystem services. And this is a big point right now due to the lift in kind of the discussion around green finance. I know that BEIS and DEFRA, for example, both have green finance teams. And this is why it's important that accounts consider both dependencies of economic activity, but also impact on natural capital assets. This ensures that there's greater importance being placed on maintaining natural capital, which Catherine's already touched on, either through business sustainability, but also in terms of resilience to climate change, and also just generally these emerging markets that we have now around green and/or sustainable finance, carbon credits, and also biodiversity offsets. So accounting itself is a process. It's a data management exercise more often than not, in terms of collection as well as analysis. It can be used for evidence-based decision making, and applications that we've seen so far include things like policy and planning, understanding impact, whether that's distributional analysis or impact assessments, financing, so a clear one is building a business case for investment, and it's also a very useful engagement and communication tool. So I'm going to touch quickly on generating evidence. So how do we pull all of this information together? So we focus on assessing ecosystem assets or natural capital assets through 3 stages. The first one being a qualitative assessment, so understanding what ecosystem services are provided by these assets. This can simply be anything from like a yes/no kind of question, or a logic chain, or any sort of tool to understand what's happening between the assets and the services that they're providing. So we then go one step further and do a quantitative assessment. So we measure the change in the provision of ecosystem services. And beyond that, we then also look at the monetary assessment of economic values, either through market or non-market based approaches, by applying kind of robust evaluation methods. So where possible and available, we do use a whole host of different types of data. However, we do acknowledge that not all benefits provided by natural capital assets can be accounted for. So there's an importance to focus on materiality and to be transparent on what is included and what isn't and why. That's a key feature of the BSI standard, for example. So understanding that natural capital accounts are likely to be partial, and they're likely to remain that way. There isn't necessarily an ambition to monetize everything, but you want to qualitatively at least understand what's happening, what's there, and kind of highlight these non-monetary benefits that your assets are also providing. The type of evidence that we include varies. We tend to start with in-house data held by land managers, owners, or stewards, basically. So whoever the account is being produced for. This includes generally mapping of the accounting boundary, so understanding development of the asset register, kind of ecosystem extents, things like that. Any income that is associated with natural capital. So as I mentioned before, recreation activities, and also any organizational maintenance costs, as there's no generalized evidence base for that. We also go one step further and look at existing data held by different organizations and other stakeholders. So you might have other actors in the accounting boundary. So a good one to think about is tenant activities. So if you rent out land to other farmers, you at least know that they're producing something on that land, for example, and that should be reflected in the account as well. And beyond that, we also look at modeled data and evidence from the wider literature. So that includes things like market statistics. We use national ecosystem accounts, for example, to produce average unit values that can be transferred across to more site-specific or regional accounting boundaries, as well as evidence repositories like ENCA or the Ecosystem Service Valuation Database, which is being produced alongside UNSEA. The main thing is, though, that it's generally good practice to reflect confidence in your inputs and your values, for example, using a red, amber, green rating. And yes, main point here is really that data collection is collaborative. No one can do it on their own, and you do have to speak to each other. This is just an example of how we produce how we go about estimating carbon sequestration, really, and the aim here really at each time for a benefit calculation is to produce a price times quantity calculation. So you have your area of habitats feeds in from your asset register. We make use of academic literature to identify carbon sequestration rates. Unfortunately, there's generally an unknown around the trend, so the future profiling of carbon sequestration over time. So in most cases, we assume it's not changing, which is a bold assumption, we know. And in terms of monetizing it, we use the UK government's guidance on this from Bayes on the non-traded carbon value. So quickly, one example to run through is the Montserrat 2020 ecosystem account. So what we have here is a visualization of the Montserrat ecosystem extent account, or also the asset register. This captures areas of both marine and terrestrial habitats across the accounting boundary and sets not only the geographic scope, but also the scope of the account. So this is where we start to identify what assets do we have. From here, we then basically go through the motions of producing this reporting output, essentially, where you see both the benefits and the physical and monetary terms that we have estimated the benefits in. And there's a whole host of benefits provided by the Montserrat ecosystems, which you can see in front of you here. Like I mentioned, we RAG rate them, but this then starts to answer those questions that I showed earlier. So what benefits do we have? What ecosystem services flow? And what value do they provide and to whom? You can start to sort of see maybe some of the beneficiaries, for example, tourism. There's a clear beneficiary there. Carbon sequestration generally accrues to wider society, global society, things like that. And I'll stop there and I'll stop after this slide, actually, sorry. In addition, like I mentioned, we do highlight what isn't captured and why. So part of UNSEA is also highlighting supplementary information, mainly because UNSEA has quite strict guidance on what type of monetary values to include in the main part of the account, which is what I was showing on the previous slide, i.e. they have to be exchange values, so market-based approaches, basically. But that doesn't mean that other values can't be included. So for example, we have welfare values here, cultural services, and we also highlight these non-monetized benefits. So we know that erosion control and flood hazard regulation are important services on Montserrat through discussions with our local partners on island. And I will stop now and leave time for questions. I'm sure there's enough I can answer there.
Was great, Natalya. Thank you very much. It's really interesting to see how you start putting those accounts together. I know I certainly have a couple of questions, but I'm going to go over to the Slido now and have a look at what's come in over the course of both talks, and we should have enough time to get through them. Also, if anybody in the chat would like to ask their question, you can put it in the chat or pop your hand up now. So what have we got here? So one that came in quite early on for Catherine was how was willingness to pay and willingness to supply land determined?
Yeah, so good question. I saw it in Lauren's chat. So I did skip over this. I won't go back to the slide, but what essentially we were doing for willingness to accept for farmers, we were saying that we had this predicted increase in lapwings, which would say be 10, and then we would simply divide their agricultural profits as they were at the moment by that number of lapwings, and that gave us a unit cost per lapwing that a farmer was willing to sell a credit at. And the reason I didn't put, I have got the data and I'm quite willing to share, I didn't want to put it on there, is I found in other talks we get really fixated that I'm charging you £10,000 for a lapwing, and that's not what I'm trying to do at all. In terms of the value for housing developers, calculated in a very similar way, I was taking the value for that whole square in terms of the number of houses that would be built there, and the potential value of the land for those housing developments. And I used the HM Treasury data for that. And that was simply divided by the number of lapwings that were there at the moment. So that gave you then a price per credit that a developer would, that was their maximum willingness to pay. So I'm quite happy to share more details of those calculations with you if that's something people are interested in.
Really interesting seeing how different people work out the numbers. So I think we've got a few questions that are posed generally to both of you. So got one saying that how do we think integrated natural capital accounting approach is it more beneficial for contextualizing natural capital against more traditional capitals? Is that what we're looking as the main use of these accounts to translate it into traditional economic values?
I don't think the aim is necessarily to have natural capital accounts be the same as our traditional accounts. We've highlighted that we know that they're not great. Like everyone knows what the problem with GDP is. That's why we're doing this work. So it's more complementary. So UNSA is a good example where that's why they have this condition on this condition that they would prefer exchange values in the main account because it makes them more complementary and follows the systems of national accounts and makes them complementary to GDP. So the aim is there to capture what your GDP isn't capturing. When we do it for the organizations, it's the same thing. We want to highlight, that's why in our balance sheets that we produce for businesses and other organizations is that we show that private column. So this is the information that's internal to the business already. Arguably, a lot of those income rows would feature in their regular financial accounts that they produce annually. But we also have a second column, or maybe two columns, that'll say what are the benefits to different beneficiaries beyond their business, basically. So that would be things like wider society. We've done work for water companies. We've shown the benefit to their customers directly. Things like air quality, global carbon emissions, or carbon sequestration. Those are things that won't feature in their annual accounts, and that's what natural capital accounting fills. Although focus is obviously on environmental assets. So taking, for example, a sixth capitals approach where you start to look at social capital and human capital, intellectual capital, and all the other capitals, they all just start to work together. They're not necessarily replacing each other. They're just filling in all these little gaps that our traditional system has and that we're all aware of those gaps exist, basically.
A really great way of putting it. I think something we're all working towards is filling all those little gaps to the best of our ability. So following up, we had various questions about where some of the accounts come from. I think, Natalya, there's a question posed to you about whether there are any accounts that you refer to that are regularly updated, or if these are the things that you're producing kind of ad hoc every time you have a new case.
So Montserrat was an example that I chose because I actually did the first Montserrat account in 2017, and as part of a Darwin Plus project, we did their fourth one, or maybe even fifth one, in 2020. So that's a consistently produced national account. The UK national natural capital accounts are also produced annually, which is done by ONS. For businesses, the uptake has been slow, but the best example really is Forestry England. They've produced accounts for the last 6 years every year and published them on their website. There's a lot of it's a new area really around, there's a new area really around kind of showing revaluations and adjustments and using a lot of the same financial accounting terminology to make it translatable to stakeholders and shareholders and things like that. So the accounts tend to show that more so. It tends to be obviously organizations who own a lot of land, who have a larger uptake of the practice. But like I mentioned, we're starting to work with a lot more investors and understanding impact and investment portfolios and things like that. So it's an ever-growing space. It's all still quite new and exciting, but there are some examples of repeat accounts really.
Going on from that, you mentioned welfare values, and I'm just personally curious about where the valuation for some of that goes to benefits to health and things like that.
So it'll vary, and generally, so like I mentioned, so the UNSEA, not so the main part of the account should reflect exchange values, which is why welfare values don't sit in that top bit. With BSI, for example, the BSI standard for organizational accounts, there isn't a strict condition on what type of values to include, so they can sit in the main part of your account if you were following that as an organization, which is what we tend to do. We don't tend to run surveys as part of these accounting projects that we do. We tend to use existing survey values, unit values, which is why we rely a lot on data repositories like ENCA or other ecosystem service valuation databases. So willingness to pay, for example, can come for water quality, comes from EA's NWeb survey, or ORVAL, which is University of Exeter's outdoor recreation valuation tool. I always get confused with that acronym, but we use what's reliable, and we tend to use average unit values from basically national studies. Or if there is something bespoke done, that's great. But within our accounting projects, it's very rare that we have a substream to do a bunch of willingness to pay surveys, basically. We have to make use of what the available evidence is. And in the UK, we are very data rich, which is maybe surprising to some of us, but we are, especially after having worked in the OTs, you know that it's a bit difficult. So we're quite fortunate that there is a lot of different valuation evidence out there that we can already start to pull on to at least give you a nice baseline.
Interesting hearing back to ORVAL. I remember uni projects based around trying to improve the database there. Katherine, there's a question about stakeholder engagement and how much back and forth you've had with some of the stakeholders you've mentioned and what their thoughts about this as a system is.
Yeah, so I've been working, our main stakeholder engagement's been done through Amy Proctor at Newcastle University. So she's been working, she's got a group of farmers in the Northern Pennines, and she's been working with them comparing different revenue streams essentially. So what farmers would like to see coming on through the new ELMs, through environmental land management schemes, compared to what could be offered in the biodiversity offset markets. Now, the big thing that is coming from private landholders is they would rather have investment from private companies and private investors. And the reasons that they're saying that is they see it as having a lot less bureaucracy than if they were being monitored through public bodies. So I think that is a historical perception of, I guess, a hangover from the CAP and essentially farmers not having much decision over what they could do on their land to get their environmental land payments. The other big discussion point with landholders, the bone of contention is if we're looking at an offset scheme in particular, really we want it to last in perpetuity, right? A housing development is going to go ahead. We're going to have pretty instant impacts on habitats and species. But then your offset site, right now, it's ring fenced for being 30 years. And that's how it's been written down in the Environment Act. Even landholders are very reticent to sign up to that. Farmers do not want to be told what's going on in their land for more than 5 years. So I think going forward, that's going to be a real sticking point. And what we're interested in is if your government kind of policies is focused on this kind of 30-year maximum for your biodiversity net gain, what is going to come on private on stream when you're talking of voluntary carbon markets? Is it actually that these contracts are going to be quite short-lived and you're going to be having multiple credit sales, and then essentially is your carbon offset actually worth anything? So yeah, we are having these conversations. I also sit on the Chartered Institute for Environmental Ecologists and Environmental Managers, their working group on biodiversity offsets. So been speaking with ecologists as well. So yeah, we do have, but I would say at the moment it does still, it's more discussions than actual like any practical like on the ground implementation, which I think is where we're desperate to go with this stuff really.
That's actually us just about running out of time. We still have a couple of other questions that have come in on the Slido. Would you mind if I emailed them to you and then we can distribute them to the participants after the fact? Yes, that'd be great. Well, thank you both so much for coming. This has been a really interesting session. I've definitely learned a lot about the processes behind this, and I hope that everybody else has as well and found it interesting. We will be having another session next week on terrestrial natural capital that you should have had an invite for. We'll have Dr. Kat Scott from the University of Leeds and Kirsty McKay actually from Highlands Rewilding, so it'll be really interesting to hear their side of this as well. So yeah, thank you all so much for attending, and we hope to see you in the future. And yeah, I will sort the last few questions that we didn't get to and get them posted out to everyone. Thank you ever so much, everyone.
Cheers. Thank you.
Thank you.
Thanks very much.
Thank you very much.
Bye.
Thank you.
Bye.